Hi guys, my name is Torsten. I'm the founder of Dividend Stocks Cash and I got a new email. It's some time already. I did not release a new video on our English YouTube channel. I'm sorry for that. I got a nice comment asking from somebody to make some new videos, and I just recorded a German video about two interesting growth stocks. Contrary to the main name implies it's only about dividend stocks, but no, it's also about growth stocks. And I present you two growth stocks which might be really interesting. First one is Salesforce, the second one is Cloudflare. They both were hurt very hard after latest earnings. I'm here sitting in Vietnam, recording the video in Vietnam, in Da Nang. So it's a little bit hot here, but I like it. So now let's make a little bit smaller. This is our website. And let's start with the first stock, which is Salesforce. So basically what Salesforce is doing, oh my God, I need to log in first. I was not logged in on the English website for quite some time, obviously. So now we have Salesforce here. What Salesforce is doing is they try to help you as a company to squeeze out more cash from a customer. In a good way. By the way, no buy and sell recommendation here, okay? Just for entertainment purposes and learning purposes, educational purposes, very important. So they help you squeeze out more money from a customer. How do they do? They do it by giving the sales team better data, better tools with better data about the customer. They are giving better data for the marketing team, for example, to set up campaigns, marketing campaigns by email, for example. Also AI-driven. There's a little genius inside in these tools called Einstein, and you can ask Einstein, create me a campaign, give me this target audience or whatever, and it gives an output, so it's generative AI, and they use it a lot. They also have cloud offer because everything is data driven and you need to import data as a business from different sources, connect the data to make it to gain more insights or whatever, and then to share this data with all the sales people and marketing people and controller and whoever's interested in that. So it's really a universe of different tools. You can also see it here in the segments. So you have a lot of segments, and in some it works pretty well. So they are the number one regarding customer relationship management, with a market share of, depending on the source, around 22%. Number two is, depending on the source, either Microsoft or SAP, German company, with around 6% market share. So you could take 22 or 20% compared to 6% for the follower number two. So they have a big moat, obviously, and this translates in a nice long-term performance. So if you check about their performance in the long run, starting in 2004, mid-2004 till today, capital gains of 5,500%. It's not bad, obviously, but you see here some volatility. Starting in early or mid-2020. And now we had this sell-off. We make logarithmic here, and then you see here this sell-off where the stock price plummeted around 20% within one single day. Now we have recovery ongoing, but you see that we still are well below the top price, the high price. The stock reached this year $370. We have currently $242. So the question is, if we have a bargain here, let's do the quality check first before we do the valuation. And here you can see that they start paying dividends. Yeah, dividend yield currently is 0.66%, so it's not so high. I checked their dividend policy and their SEC filings. They don't give really a dividend policy. There's only a very general blah blah. But I assume that dividend might increase around 50% each year. Also because the free cash flow is so high compared to the dividends that the payout ratio is around 18% only. So there's still much space left to increase dividends. By the way, I need to tell you why there was a sell-off. The sell-off was related to lackluster outlook regarding first place revenue growth. Revenue growth should be around 8% only, so single digit. Before it was much higher. You can also see it here. So the revenue growth was around 20%, and now we have only around 8%. And this is disappointment, of course, and wakes doubts about their strategy, if AI is going to work and whatever. But it might be also a nice buying opportunity, because you can see it here. Salesforce got a more efficient company within the last 2 years. You can see it here that operating margins, they really jumped from 2% to 80.5%. This is thanks to a restructuring program, and you can also see the benefit or the outcome of this restructuring program here in the profit and loss segment. You have here the last 12 months, and you can relate the operating expenses to the sales. And here we have about 12 billion difference, and in 22 it was only around 5 billion. And you could also compare here the the single items here, like general administrative stuff and so on, which it's hardly increased, although the sales increased a lot. So general administrative and others was 12.4 billion, 22, and 12.6 billion only 2 years later. It was thanks to firing of workforce, and they also reduced their footprint in the office space. So Salesforce got a much more efficient company right now. And you can see it also here in the margins in first place. We have, by the way, big difference between reported earnings here in green and adjusted earnings here in brown. And this is due to stock-based compensation, to restructuring costs, and due to amortization of software from companies they bought, because they buy a lot of companies. You can see it here, the goodwill is rather high. Half of the balance sheet is packed with goodwill. But I think they know what they are doing. Here they bought Slack in 21. Yeah, exactly. And there's always a question, can I trust the adjusted earnings, or is it complete bullshit from management? You can, quick and dirty approach is to check if the operating cash flow is closer to the reported or to the adjusted earnings. And you can see here that the operating cash flow is much closer to the adjusted earnings. So you can take this not for granted, but you can take it seriously, okay? Now we are coming to the valuation. We go to the multiples first. And we have here all of different metrics, multiples. Often I use the price earnings, also multiples based on the price earnings. Here I will not do so. I will use the multiples based on operating cash flow. Why? Because the operating cash flow is here the better metric to create later the fair value and get an idea if the stock is expensive or not. Because here you can see in these years the adjusted earnings were so low that this is why the price earnings were so extremely high. Here they were so extremely high. And when we do this, we can see we are currently right now here with a price earnings of close to 20. In the medium, on average, it was around 30. So it looks, the stock looks cheap. Then you see here in the forecasts that we have here declining multiples, but here's somehow the multiples go up. This is because we have here slight decreasing operating cash flow according to analysts. This is not true, or this is there's somebody made a mistake here. I will show you how you can find out this very easily, and I can also show you how to handle this. So everything here is very transparent. That's the good news. Everything is connected, all charts and everything is connected to each other. And if you find so strange anomaly, you can sometimes even detect what's wrong and then make your own workaround so that you don't need to bother with this. I'll show you how it works and how you find out that there's an error here immediately. So fair value. I use this pro version. I'm a professional in this tool at least. So now we are going to select the operating cash flow. When I do so, we have here in the tooltip the different estimates and the range of the estimates, and you can see here that the range starts with $0. $0 means somebody estimated that Salesforce will have operating cash flow in January of 26 of $0, which is not really authentic. So this lowers the whole consensus estimate. Okay, this is why we can't take it. But we can take this one. There are still 5 analysts estimating this, and obviously this error is gone here in this for this estimate for January 27. Okay, now we have here what's also important is check out if here the analyst estimates are reliable or plausible. And here we have, for example, this is the estimated sales growth, estimated operating cash flow growth. And I'm just watching. Okay. Here we see that we have a line break. That's not good. We have to address that. This here is the estimated revenue growth. It's 8.6% for the running current business year. And this is in line with what management indicates with the current quarter of 8%. So this is how you can verify if the consensus of the analysts match your own expectation or is realistic for you. All the analyst estimates here are current or are recently made within the last 90 days. So what we can see here is regarding the operating cash flow, which is this line here. We have growth rates of about 30%, and then around here this minus 2.6%, you cannot use this. Here 70% based on here somewhat lower, so this should be around, I don't know, maybe 50, 12, something between 12 and 50% normally. And this is already, I think, a decline regarding the growth rates here in the past, okay? This is why I decided to make an adjustment for the calculation of the fair value. So we have the fair value out of the box of this stock, and I zoom in a little bit, would be for the current business year close to $400. If you compare the stock price is $243 only. So it's clear undervaluation. But this is based on a calculated fair value based on an earning or based on a multiple price to cash flow of 29. I lower this to 22, and when I lower this to 22, and when I do this, we still have undervaluation. And when you see here that the stock price respects this 22 price to cash flow fair value starting from mid-2020. And now we have this undervaluation, and now we have annual expected yield for 2.5 years, for each year of 15%. And this to me looks rather attractive. So Salesforce for me right now is an attractive stock. Is this also true for the second one? Let's check out. The second one is Cloudflare. Cloudflare is also market leader in its niche. Cloudflare has a niche. Here you can see what Cloudflare is doing. Cloudflare is a cloud hosting service, but you cannot host your complete IT infrastructure on Cloudflare like you can do with Amazon AWS or Microsoft Azure, for example, or with the Google Cloud. It is only a cloud for security reasons in first place, and with a content delivery network for performance reasons. So this is the main thing Cloudflare is doing. But this they are doing very well, and they are the market leader there. Depending on what source you take, you get really crazy numbers. For example, 20% of all websites should use Cloudflare, or top 10,000 websites in the world, even more, even a third or something like this should use Cloudflare services. And regarding DDoS and bot protection, they have a market share of 80%, so they are really market leader. I will not discuss about the numbers by Digit. You can add a comment and give me your numbers, but they are really market leader in this niche. And it's a big niche. We are, for example, also customers of Cloudflare, by the way. And the stock price also dropped. You can see it here in the performance chart, year to date. Yeah, exactly. And here the stock price dropped around 60% because of a lackluster outlook. The numbers for the last quarter were good. They beat estimates, but the outlook was not really bad. I tell you the figures. The consensus estimate for the revenue was 394.5 million. 394.5 million. And management said, we estimate 394, so just 500,000 less. So it's a 0.2% miss or something like this of what analysts estimated. And the stock price dropped. And the stock price dropped again here around 10% once more. And now we have a slight recovery. And we have losses, if we look here, year to date of 14%. And no dividends are paid here. Might also be a bargain, we will see immediately. If you go to quality check, you can also see a difference between adjusted and reported earnings. You can see that the operating cash flow is much closer to the adjusted earnings. And it's about stock compensation mostly. The difference between reported and adjusted earnings. You can see here rising margins, growing margins. They have this very solid balance sheet without much goodwill. We have more cash than interest-bearing debt, for example, which is also interesting. Here you can see it. So it's a good balance sheet overall. And you can see here that you have dilution of your stocks by new stocks. Obviously going to the employees on first hand, but you can see also that the dilution is not so big regarding organic growth. So let's go to the valuation and let's check the multiples. Multiples are really high. You can see here multiples breached 1,000 even here in 21. We use the operating cash flow, same as we had done for Salesforce. And we now have a price to cash flow ratio of around 70, something like this. And here you see the average 250. This is meaningless for current valuation. I think we should take starting of 23, for example. And then here, this is maybe more realistic range of price to cash flow. And here we see dynamic decrease of cash flow because operating cash flow of price to cash flow because operating cash flow is going to increase rather aggressively. Yeah. And we have here price to cash flow of 46, for example, in October 25, according to estimates. Okay, now let's go to the valuation. We use the operating cash flow to do the valuation here, obviously. And we need to change that to update the price to cash flow used to calculate the fair value because it's much too high. And what did I think about that, how to do that? I looked at the operating cash flow growth. Here we have no line break, by the way. And we have here operating cash flow growth of around 25% each year. And I said to myself, okay, it's a good company. And you might still say you can pay up to the double of the growth. So you mean price earning growth of 2. So with a growth of 25, you multiply it by 2, then you get here a multiplier of around 45 I use 22.5 growth as growth rate for the operating cash flow, okay? So 45, and if I do so, we see dramatic decrease. And now the stock is not inexpensive anymore or cheap, but now we have an annual yield or a total yield of -2% till expected total yield of -2% till end of 25. In other words, in my point of view, the stock is still not cheap, but still, yeah, rather expensive. I would suggest that you put a price limit here on this stock. You can add here the, where is it? Where is there here the valuation lines? You can, for example, calculate your expected yield with a price of around $60 for the stock. And I missed, so now I got it. So yeah, $60. Then you have an expected yield of 9%, a little bit more than 10%, or 50% completely till end of 25. So you can put your price limit here. Where is it? Okay, it's not here. I must add the color. Price related matrix. You can buy a limit, and then you can put it here and say, okay, $60. And when it's reached, you get an email, okay? So this is how it works. Nice tool, nice tool. Not only for dividend stocks, but also for growth stocks, as we have seen here. Okay, I now presented you in our video, with two stocks, two growth stocks. Next time we will be back with dividend stocks, cash, and I hope it won't last too long time until I make the next video. Okay, thanks for watching. You can drop me a comment below which stock you would like have to analyze. And see you next time. Bye bye.